Welcome back. You're watching HFO-TV.
Hi, it's Greg Frick, HFO-TV, here with Jeremy Snow of Colliers Valuation. He heads the multifamily department here in Portland. Thanks for coming.
Thank you for having me.
We'll talk a little bit about valuations and what we've seen in the market of multifamily. Maybe you can give a little background on how long you've been in this market in terms of the valuations, some background on you for the audience.
Sure. I've been appraising since 1998 and appraising just apartments in the Oregon and Southwest Washington area since 2002, originally with PGP Valuation, which has morphed and changed, same company still over the years, right. And now we're Colliers Valuation and a publicly traded company under the Colliers symbol.
Okay, so. And you do everything in Oregon, all through Washington, size range and multifamily. I know we've done a lot of deals together, institutional all the way down to a 20 unit in the market.
Yeah, and so at this time I have myself and then 5 others that are on my team. All we do is apartment and multifamily related appraisals in Oregon, all over Oregon, and then Southwest Washington up to about Longview. So, but we do a significant amount of affordable housing. So because we're doing affordable housing, we're literally everywhere from Medford to Milton Freewater, Ontario, so we're all over the state for the affordable housing stuff.
Gotcha. One interesting trend we've seen for the last few years has been the acquisition rehab or reposition play on some of these. It started in the 1970s projects, now we're seeing it in a 90s project. And I know from an appraisal standpoint, it's kind of a little bit of a different of an appraisal in terms of maybe you can explain a little bit on the acquisition rehab, how that differs from just a standard purchase of a multifamily deal. On the appraiser, how you look kind of at as value and then future value. Sure.
Well, it kind of depends on the lender, but most lenders are most interested in what's the value that they have right now, because they're going to make sure that the property they're making a loan on right now is the value. And so most people want to make sure first, hey, if someone's buying a property for $1 million, is it worth $1 million? Right. So the first thing we do is appraise the property in its as-is condition. After that, then the lender wants to know, hey, if someone's going to put in $10,000 to $20,000 a unit for renovations, is that feasible? Is that a good investment for the buyer? Right. So then in that scenario, then we take a look at what renovations are going to be done, what upgrades are going to be done, how is that going to affect the rent levels of the property, how is it going to affect the expenses of the property. So theoretically, if someone's buying a property for $10 million, putting $5 million into it with renovations, hopefully then that value is going to be over $15 million when it's done. And in general, most of the sophisticated borrowers are working with, in general, that's been pretty feasible these days, especially in some tight submarkets like a Gresham submarket. We're seeing that pretty often in a few deals these days where nothing's been built for a few years, and so buyers are seeing that there's some pretty good rent bumps that can happen because that new luxury market, like in a lot of other submarkets, really isn't out there. Right. And so they can hit that with some nice renovations on some existing properties. Okay. Which brings up on the new construction side, because I know you guys do appraisals on new construction for construction loans. Yep.
How are you looking at, how do you look at something that's going to be built, completed in 2 years? And we've had just substantial rent growth for the last, humongous numbers in rent growth for the last 2 years. How do you look at that as you continue that trend? I know you're not asking to go into crystal ball, but what do you do on something like that? Sure,
no, that's definitely a significant question. I'd say 2-3 years ago when we were doing these construction appraisals, everybody had very rosy outlook. Because there was such high demand. Right. And rates, people didn't have any worry about interest rates increasing either. At this point right now, people are a little bit more worried with the number of new units in the market, and also there's some pretty significant thoughts that interest rates are going to be increased and at some point here in the next year, maybe even the next few months. Right. And so at this point, some lenders want values hypothetically as of today. So sometimes when they order a construction appraisal, they want to know if the property was built today as it's planned.
With these rent levels in place today.
Exactly. What's the value today? Some lenders want to know, hey, what's the value of it in 2 years? And with trended rents and considering expenses at that time. And actually, some lenders want to have both of those scenarios in one appraisal. They want you to estimate the rents today and estimate the rents in 2 years. Got it. So sometimes it can be a wide mix of what the lender wants. And in general, though, we're still projecting rents to be increasing slightly over the next 1 to 2 years. I think it's going to be less than it has been over the past couple of years when rents have been going, crazy. Who knows, 6 to 12% depending on the submarket or property type. So I think it's going to be a little bit less. But in general, I would say most people are still projecting some rent growth, maybe 1 to 3%, 1 to 4% depending on the submarket. But then, in general, people are expecting capitalization rates to probably increase over the next 1 to 2 years if interest rates increase.
Tied with interest rates, because we've seen the continued compression of cap rates, and we've even seen it in secondary markets now.
Absolutely,
tertiary markets, we're seeing this compression.
And so cap rates have been decreasing definitely over the last 1, 3, however many years. But people generally expect cap rates should increase over the next couple of years, depending, again, nobody knows when, but at some point. And that also could be coupled with, especially in more urban areas, maybe where there's so much new product. If rents maybe get hit with a little bit more concessions or rent growth isn't as strong, then the cap rates are, that also affects the cap rates as well when people aren't projecting as much rent growth. So overall, if we're doing a proposed appraisal for a property 2 years out, generally we're expecting, a little bit higher rents than today, but a little bit higher cap rate than today. And so we've done a couple of appraisals where we've done both, and literally the value, if you're looking at the value today versus the value 2 years out, is literally the same.
With even with increased rents, but we make the adjustment for the cap rate.
Yes. So in general, again, that's just everybody's best estimate at this time, but it's been interesting to see how close those values are. So.
And I know you guys do work with a lot of different lenders. I mean, as the appraisal business, the lenders are really your clients. Do you see anything from them in terms of, hey, what they're asking for, or what what their kind of hot buttons are in terms of maybe what their concerns are, what they're comfortable with, and hey, this seems to be a hotter topic with the lenders today than it was 6 months ago. Is it job growth? Is it wage growth? Is it in terms of vacancy rates? Are they asking you guys those kind of questions, or this is what we want to see in the appraisal?
I would say that each lender is really different, and so it can really vary depending on the lender, the underwriters that work at the lenders, the credit people in their credit departments. And I don't have a lot of contact with those type of people always. I have contact with the appraisal reviewers. But in general, the biggest question that I always get asked by the reviewers and/or loan officers that call is just the number of units coming into the market, where they're coming in at. Hey, we're looking at this project, it's in this little area. What do you think about it related to the other new construction or that kind of a thing? So I would say the biggest, question and concern that most lenders have for the new construction at least is the rent growth, concessions, vacancy, that kind of stuff. But for older projects and maybe suburban markets, that kind of stuff, I would say most people are pretty, don't have too many worries on those because, they're existing, they're not going to be competing directly with the new construction, and in most areas vacancy is very low. So in general, I think a lot of lenders are fighting over those, good, stabilized 1970s, 1990s properties because there really isn't too much risk, at least that the market is seeing at this point for those.
It's a different kind of
on the lending side. So.
And any sub-markets in terms of tertiary markets, I mean, we've been surprised at the compression of cap rates in the secondary markets. I'm sure you're seeing that as well. And I think a lot of that has to do with the lack of new construction in those markets. You've got increased demand. I'm sure you can echo kind of some of those thoughts as well.
Yeah, absolutely. I mean, anywhere from Salem down to Eugene, cap rates have definitely come down over the last 1 to 2 years as well. Just because cap rates are so low in Portland, people, local investors, aren't wanting to pay the, 5 to 6, 5 to 5.5 cap rates on some of this new stuff. And it's been really, I got asked the other day, somebody asked me on the new construction stuff, the stuff that's been sold, what percentage of buyers are local? And really, I had to think about it, and I was probably 90% are from out of the state. And so all the people that are local here that are building or buying or selling, the cap rates have gotten compressed so much compared to historical levels that I think a lot of them are having to look at other options, other areas, because they aren't, excited to pay those 5 caps as the California buyers are. So they're looking at Salem, Albany, Eugene. I just did an appraisal in Umatilla the other day, even from a Portland buyer. So cap rates, whereas a cap rate for a decent property in Salem, 3 years ago was maybe 6.5. Now, you know, it's down to 6, or
right.
you know, ballpark 6, or maybe even lower for, you know, for a really nice product.
But it's still a spread over what you're looking at in Portland Metropolitan area.
Absolutely, absolutely. You go to those areas, you still get a higher cap rate, but values have, you know, it used to be tough to get over 80 a door in Salem, and now, you know, properties are selling for over 90 and 100 a door
right.
without even issues. So,
well, that's been a big kind of thing we talked about with some of the local players or local investors here. That adjustment to, yes, I know that's where it was 5-6 years ago. But if you're going to want to continue, there's been such high demand. We've seen compression in cap rates, rapid increase in rents. Couple that with the price per unit. It's been hard, I think, sometimes for people that have been in the market for so long to get their arms around, hey, wait a minute, I remember when it was 70 a door, now we're up to 90, it just went like that.
Right.
And so it's been interesting to see that. We've actually seen more of the locals kind of coming back saying, okay, that is the market we're in. Maybe we need to make an adjustment. So I'm sure that's helped on the
right. And one of the more interesting discussions I had with an out-of-state buyer the last couple of months was they were buying a brand new property here in Portland for one of the highest values ever seen for a suburban property. And I said, hey, you know, does this value per unit give you any worry? And they said, no. You know, we're selling properties that were built in the 70s for a 5 3/4 cap rate, and we're buying them at a 5 1/4 cap rate. So, or, you know, 5 to 5 1/4 cap rate. It's like, it just makes sense to us what we do. We're long-term holders. We're going to get rid of some of these older properties that we knew we're going to have long-term capital expenditures. Right. We're buying brand new properties for only, you know, 50 basis point spread. You know, that makes sense to us. We don't care what the value per unit is. We care about that cap rate and what makes sense for us in our long-term strategy. So I thought that was, you know, really interesting.
Well, they're not jaded by the historical price per unit. And I think that's been an interesting thing in education for a lot of people in the market. If you go back, it's, if you want to talk about price per unit historically, well then let's go back and look at where rents are historically as well. And you see they're going to go together, but it's a lot of times it's really hard for people. That's in our industry, you hear a lot of price per unit. Right. We're seeing these numbers that on the surface look astronomical, but like you said, you look at the cap rates, we've had a little compression, but it's, you know, we haven't had 200-point compression in cap rates. It's been the rents have increased, and it's just the market that we're in.
Right. Yep.
And so much capital looking for places to go.
Mm-hmm.
What are you seeing in terms of percentage of acquisitions versus refi in kind of your work? Is it?
Yeah, you know, 2 years ago, refi was the majority of it because there just wasn't a ton out there. Now with values being so high, cap rates coming down so much, and I think a little bit of more interest rate worry now than there was, there's a lot more sales going on over the past 12 months, and so, you know, I don't know what our percentage is, but, you know, if it was 80-20 previously for refis, it's definitely closer to that 50-50 now,
it is now. Okay.
Than it was. We've been doing a lot of purchase transactions over the past, especially in 2015. So that's definitely much more active than it was, because I think the potential sellers are, you know, wanting to make sure that they sell their property before any of these interest rate risks happen that might, you know, bump cap rates a little bit. Again, most people I speak with don't think the cap rates are going to go up much, even if interest rates go up, just because there's so much demand.
Yes.
But I think, you know, some people still worry about it, and, you know, it's kind of an unknown. So. And
from our standpoint, we saw this turnaround in terms of transactions was led on the institutional side first. Mm-hmm. And I think the last year and a half, we've seen the private client, under 15 million, really kind of take off. I think some of that's been, hey, you know, if I can get this value, maybe it's my opportunity to get out. We've also, I think, seen the local buyers who are locally based saying, this is the market we're in, we've got to play in this. So you're starting to see more of that, you know, transaction flow on the 15 and under of the exchanges and moving around, I think, which is interesting because usually you think it's the other way around, but the institutional drove it with the capital coming in here, and now it's kind of driven transactions up, volume up, and is continuing this cap rate compression.
Right, yep.
Yeah. And then you guys do a lot of, you know, low income or subsidized. Any change in that market at all in terms of, you know, I know questions about affordability. Are you seeing more of that on lines in terms of potential development, or is it just kind of the same flows we've seen before?
When it comes to the low-income housing standpoint, the funds are essentially controlled by the state. So the state has X amount of funds that can happen per year. So there's just kind of a typical development cycle that occurs when the state awards the funds. And so that's kind of a thing that happens every year. So, you know, I don't know how many numbers of projects there are built, but let's say 10 to 15 new projects built every year. And then the existing properties, you know, go through the typical refinance stages like any other apartment after the fact. So, you know, after 5 to 15 years, those projects are going through the typical refinance process as well. With the rents going up as much as they have all over the Portland and the state, you know, whereas 5 years ago, many of the tax credit projects were not at the maximum rent levels. They were at needing to rent their units at rents that were lower than the maximum tax credit rent levels just to compete in the market. But now we find that it's much more common for projects to be at the maximums everywhere in the Portland metro area, and then even in some of the secondary markets, the rents in those areas have increased enough that the rents at a tax credit project is at the maximum now as well.
Got it.
So that's one thing that's become more common to see that we didn't see a few years ago.
So you're seeing that spread significantly more than where we were 2 years ago.
Yes, absolutely.
And anything I always ask people is, in terms of, in your line, is there anything you're looking at, or what are you following in the next, kind of what are some of the things you're looking at to say, hey, this may be a sign that things are going to continue, or a sign that we got to slow down, or is there anything you see in the horizon that causes concern or causes you to get excited about that this party's going to continue on for
Sure. I think a couple of the interesting things that I'm looking forward to is 12 months from now, what's the urban market going to look like, the close-in side with with many thousands of units coming online? Are those units going to affect the existing units at all? Is there going to be more concessions? What's going to be happening? I don't think anybody really knows until that happens. I think everybody that I speak with generally thinks there's enough population growth and enough existing people to take the units. But at some point when there's many thousands of units being built, is that how's that going to affect things? Okay. So that's one of the things I'm following. And then I'm also interested to see in some of the markets where we haven't seen very much new construction, like a Gresham, like a Vancouver, like some of the other areas where there, especially in the Gresham area, there's really been no new construction for a number of years. Rents are going up there significantly. Yep. We've had a couple recent sales there with low cap rates. Vacancy is virtually none. At some point in some of these other submarkets, are we going to start seeing some new construction where it hasn't been feasible before? Right. Some of these areas, so I'll be interested to kind of see how that happens over the next couple of years, as maybe some of the markets, maybe they slow down a little bit because there's been enough units built, or we'll see, and maybe some of the developers that have been building in those one area, like, hey, I can go out to Gresham now. Now
I've got rent levels now that are making it justifying the cost of construction.
Right. So I'll see if the construction moves around the MSA at all, or kind of what happens. So.
Yeah, interesting. Well, thanks again for coming. It's very enlightening, and we'll see you next time on HFO-TV. Thanks. That was good, man.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.